So my friend Rebecca at Salt Whistle thought it was worthwhile putting together a few thoughts on the retail business that I've picked up over all of the years, generally dealing with restructuring and selling assets to better performing businesses. So I thought it was worthwhile to distill that down into something which will be bite-sized, hopefully interesting and worthwhile if you just want to distill a couple of things to think about how you can improve the financial performance or protect your business going forward, particularly in these times where there's material uncertainty in supply, margin. We won't mention the T word, and all of the normal competitive marketplaces that we have over the top of an economic downturn potentially as well. So it's one of those things that I think is relevant right now, and I hope you find some value in it. Thanks.
Fashion brands in the now global marketplace.
What's happening in global fashion and how brands staying relevant and going forward while all of this uncertainty comes through, particularly when you have the issues coming out of the US and China looking for new regions, although you have pressure on people spending money in a lot of Australia and around the rest of the world, particularly in the higher end, even the larger global fashion brands in the top end are struggling to get their sales back to where they were 2 or 3 years ago. So, what is the successful mission statement or the successful mix that these brands are getting through? It's about the relevance and pulling that through. Relevance is for the consumer. So, each of the brands have a relevant for each of their target markets. What they need to be able to do is build enough of a consumer base to create the relevance and also create a business that justifies what their investment. So you need to have a wide enough and deep enough customer base that you can then appeal to so that they will buy your product. Obviously, that is driven these days a lot more by digital means, including social media, influencers, and things like that. So that means is that those brands have a lower cost base because they don't have bricks and mortar, and they can spend that money and directly pitch to their customers if they have enough of them. The issue is how do you get enough of them and how do you find that brand relevance and what is your position in the market? There are a couple of brands that I know are really successful in this. I can't wear them because they're just the wrong style for me, I swim in them, but I can understand why they would be successful. For like, obviously, there's an explosion in certain brand areas as well for certain types. For middle-aged men, there's probably an explosion in golf brands and different golf styles because it's their sort of attraction. The interesting movement is probably away from fast fashion, but then you have the impact of Temu and all of those things coming out here as well, which uh, is really impacting bricks and mortar in their target markets. So it's about trying to find that relevance that gives you a niche and can secure a customer for you and enough of those that will buy your product to be able to make that work. And sometimes you need to sacrifice a little bit of the extra potential of sales to make your product a little bit harder to get. And there you get value build up as well. And that's where up at the upper end, that's where the premium brands are, where they drive desire for it and limited numbers and then value. Whereas in the middle market, it's more, there'll be more volume, but there's still a scarcity. So it's building that scarcity and that desire for somebody to spend their money, open the wallet. And that's how you get the build up of brand relevance where people will return and it continues to stay relevant for them to keep buying rather than being a commoditized one at the bottom of the market, which is, well, I just need a pair of underpants or I just need a t-shirt. I just will buy a commoditized one rather than one that is three times the price, but is really cool. And I know it's really cool because my brand relevance is telling me that it's cool and it's hard to get and all of those things. So customer expectations are continuing to change and will continue to change going forward. The market is much more fluid in that expectation. The reason being is that there's so much more proliferation of brands from across the world. 20 years ago in Australia, you could not buy the UK brands. It was scarce against scarcity and relevance. It was a sort of pseudo premium. I think one of the, best example is probably Stella Artois is a lower end beer in the UK, whereas here it's a premium brand because it's imported. It just shows you the different markets. Whereas now, a lot of these younger brands and a lot of these imported brands really understand their customer and they really target them and bring them a product that they really like. Whereas some of the brands which have an expectation or a requirement for people to come to them rather than them coming to the brand coming to you, they have missed the mark and have become very difficult to find their relevance because they have just lost their customer base and their customer base becomes distracted and finds something else relatively quickly and easily. Whereas previously you were stuck. It was another example is like the four channels of TV we had back when I was a child. Whereas I don't think I've watched terrestrial TV for 3 years or 5 years or whatever it is, because there's such a proliferation of all of the other things, and you have so many streaming services, you don't even know which one you subscribe to. It's a similar thing with brands. If you find a brand that you really like, you will probably stay with them because you feel relaxed and confident with them. But some of the other brands fall by the wayside because they've been replaced and they've moved past it. And in Australia, we've seen that with Mosaic, a collection of brands which have been around 20, 30 years and were very popular in the 80s and 90s and whatever else. And then there are other ones under pressure like Country Road. We had a shoe brand fall over this week. We had a fast fashion fall over 2 weeks ago. It's really working through how how you can continue to keep the attention of these people. And in the Netflix age, it's really hard to get people to maintain their attention. And you've also got a global challenge. So you're talking about a competition level which has gone from us being a backwater in fashion a bit to being much closer to being a Paris level. Probably we're never ever going to get to a Paris level, but we have capability. If you really want to, you can order on Pret-a-Porter, you can order on all of those things that never existed down here and get delivery. All you have to do is be willing to sacrifice a bit of time and the pain of getting Australia Post to deliver something to you.
Black Friday and its impact on retailers.
So let's talk about the main game for many retailers, particularly in fashion, which is Black Friday. And Black Friday drives budgets, it drives profit, it drives success of businesses. A poor Black Friday can lead to a really poor performance, impacting working capital, impacting the entire business, and creating material uncertainty about whether it can actually continue. Because execution of Black Friday becomes one of the critical aspects for a lot of these businesses. It's the day where massive turnover comes. It's like the new Christmas. Previously, there would be a build up to the Christmas period, and you'd be able to maximize your revenue and you'd be able to maximize your position and at good margin. These days, it's really, really difficult to be able to do that because we've also converted to a sale mentality, and there is constant sale, constant discount, which didn't exist. The top end of that is Black Friday, where everybody has a feeling of being able to spend money. So because of that, that means that you end up with people wanting to buy and you don't have to negotiate with them in the normal way where you've got to provide value to them. They want to buy. A lot of brands then go and produce specific stock for Black Friday and discounted stock for that to be able to pump through volume. But if that stock again is not relevant or doesn't hit the mark, you're left with that specific stock and you've got to trade through it, unless you can get rid of it on Digital Monday, which is a lot more difficult. And then Christmas follows with that. I think in Australia this year, Black Friday was a little bit hit and miss for a lot of brands, and then Christmas was even more so. So if you rely on Black Friday and then hope that you get out with Christmas, then you've got your cash available for the rest of the year that funds you the rest of the business as you build up again and build your stock through. Because there will be some brands who may not have ordered for winter this year because they had a poor Black Friday and they just don't have the funds to be able to do it, or they'll be scaling back orders, hoping for a mild winter in Australia so that they can use summer stock and last year's winter stock to be able to see them through. But again, that goes back to your relevance. How do you maintain your relevance then if you're using stale stock and old stock that's not as appealing as somebody who's got the new season, new style that hits the mark? It is a very fine balancing act to be able to do that, and that's where sometimes the art in retail and fashion has to try and drive a performance as well as the practicalities of trying to produce a margin. And that's why there's only a few people who are really good at driving those mid-market retail businesses.
Maximise your opportunities with real live forecasting.
One of the things you can do to help manage your business when you have pressure on working capital and also issues around your stock is real live forecasting. And that involves building conservatism into your numbers. So rather than ordering 2,000, you order 1,000 or 500, and you have planning for dumping more if you find something that's successful. That obviously plays around with your margin, but it also means that you're not parking too much money in your working capital or stock that you got to get rid of in the future. So it's actually adapting and being realistic around things and looking at it with an expert. I'd often suggest you get an external expert to come through because they will be able to look at it rationally and they will give you a viewpoint from somebody who is familiar with the market and how it will work rather than just trying to estimate based off last year because everything changes less than, I mean, look at what's happened in the last 2.5 weeks in America with our new tariffs. That has had a material impact across China and has had a material impact across the world. If you don't adapt for it, I mean, there are stories going around of people, businesses in America who supply outdoor furniture, and in between the time that the stock left China and have arrived in America, they are now liable for on $60 million worth of stock, they've got to pay $85 million worth of tariffs. And all of the stock coming out of China has the pricing on it that's been built pre all of this. So then all of that needs to be changed. Everything needs to be adapted, and the whole pricing model changes because you're just literally passing on that tariff. So that's a good example of how you need to be adaptable to find your market and to be able to say, this is where the market's telling me it's going to fit. And I haven't sold through enough of these, so I need to change my pricing model to get rid of them. Otherwise, I'm going to end up with excess stock. What does that mean? And where's your stock sort of timing? Aside from that, it's always looking at alternatives, whether you can go into the US. If you're Australian now, is there a way around the tariff structure or whatever else, and people will adapt to that? Or is Europe now going to become more welcoming that everybody seems to be wanting to create a trade position away from the Americans? So, and the other thing is looking at it and restructuring it. So that leads you to look at each of your stores and each of your product styles and saying, do I need this? Is it profitable? Is it adding to my bottom line? I know it's really, really cool. I really, really like it, but is it making any money? I've sat in meetings where we've had discussions around high-end jumpers, which look a little bit like Kmart options, and that was not taken well. But I'm definitely not a fashion critic. I can't argue about that. But it's about trying to work out, okay, what is this supposed to do with this product and how does it fit? And there are other passion projects with a lot of fashion designers. There's a limited scale for that, I think, other than if it's a really successful sale item. And we've had it certain things on Lisa Ho. We had the most successful product we did, the most successful order we did was buying 400 pair of leather pants, having them shipped from China, arriving here and sold them all and made probably close to a 5,000% margin in about 4 days. And some of those things you just got to make those decisions and make and hope that they do that. But if you know that there is volume there and you know that, and this is where the retailer's got to really trust their judgment and balance that with a little bit of conservatism. But if you know that it will sell, you need to get it there at the right time at the right price. And that's the art, the other art or the science of it, balancing out with the great design and the great product.
Manage your supply chain to be more successful.
Supply chain management is pretty much the way that the really good operators find a way to be able to massage their margins through good times, bad times, up times, and anything happening. They can manage it to the nth degree because they understand and they have a great feel for where their market is, where their customers are, and where it's going to move to. So they're very organized. They understand when they need to order. They understand their volumes. They tinker with that constantly. It is like a bit of a mad professor playing around with it and watching the numbers constantly so that when things move, they can adapt instantaneously. Obviously, automation and AI are coming through that process now to help them because there's a lot of processing that goes on in a lot of heads, and even down to what's the weather going to look like on the weekend? Do we need to have t-shirts in the stores and what color should they be and things like that? But it's about being able to understand your supply chain, how long it takes to get from somewhere to there, what the costs are, making sure you understand that and it's all included in your margin so that you can go, okay, if I get an extra 400, I know what I'm making. Even if I only sell 200 of them, I know I'm breaking even or I'm making 10%. And if you can do that and you understand it, it's just giving you the benefit of decision making that you don't get if you don't understand or you think you do, but it's not as refined as that. And that also means you've got to have great relationships with your suppliers and you've got to be able to lean on them when you need them for extra or to reduce to massage that through. And that's probably one of those aspects where the precision comes through and there's a little bit of luck because you are going out over your skis a little bit and trying to plan for it and hoping that it comes off. And sometimes it will, I suspect. And the successful guys do that more than what they probably don't. And then they come up with a first loss, best loss sort of scenario and go, well, it didn't work. Let's move on. And don't be fearful of failure. You've got to be willing to be able to take a chance, but you've got to do it within your capabilities so that you're not creating a problem by taking a chance. You've got to be willing to take a chance to see whether you can make it work. And you've also then got to be able to make sure that you cover yourself in the loss. It's not gambling running a retail business, although some people I have dealt with because of what I do seem to think it is gambling where it's all or nothing based off a design. And I don't know whether they've got that from the movies or whether they've got that adaptation because they're now, I think they're the entrepreneurs in that sort of area. But these have great business underneath it, but one big run at something for a big season has been created a big challenge for the business.
Transparency with your suppliers can help you.
Transparency with other suppliers, other clients, everybody across your supply chain and in your business is really critical because if you offer a solution which is never ever going to happen, your credibility around that plummets straight away. And if you continue to do that, your credibility just is forever gone. I mean, in what we do, we always have to be able to be confident that what we are asking or what we are proposing is capable of delivery. So under offering or under proposing and over delivering is almost a law for us. Because if you can't deliver on what you are presenting, people will just lose interest very quickly and you can't actually deliver the overall structure because there's lots of different people moving around in that business. And if you're a retailer and you need, again, support from your suppliers because you've had an inadvertent event, COVID shuts you down, or a tariff issue happens and you don't want to supply, you've got a cash flow problem because somebody's defrauded you, all of those things. And guess what? If one of those things is happening, there's a chance that the rest of them will happen, or at least in different batches. So you get hit from a number of different sides. So if you really have good relationships though, and you have experienced relationships where you've been upfront and honest with everybody, and you have a personal relationship as well where you can actually ask them to trust you and they will trust you, that will get you out of a lot of tight places through the process. It'll save you money and it'll also give you an opportunity to be able to buy time when that's probably what you need. Because a lot of the things we see is businesses buying enough time and being able to have conversations as part of a plan. So if you can put a plan together and understanding about how you can get through something, and then you can communicate it with the parties that you need, even if the asks are pretty difficult and they're unhappy with you, you give yourself an even chance of them contemplating it at least by having a good relationship with them and having been upfront with them and honest with them and telling them what your plans were through hopefully years of working together before everything goes sideways. And it's the same with professional services relationships, right? If you have known somebody for a long time and you've always been credible and you've been honest with them about everything that you've been doing up to whether your golf game's any good, which is always a little bit flexible, it's always better to be upfront and clear. And otherwise, everybody has to make their own determination, and that is up to their own assessment and perspective, which is not necessarily helpful for you if you want to be clear with them and have a professional relationship and then progress beyond that into a little bit more than a professional relationship where you actually have an association, a friendship, and going into trust. And I talk to our young guys about trusted advisor relationships, which is you don't set up a trusted advisor relationship in 3 meetings. You set up a trusted advisor relationship over small bits of pieces and information that you can help people with and using your network to be able to help them with things and finding solutions and spending time on doing that and also going to war with them on certain issues, and being able to go through processes and go through a restructure or go through a sale or go through whatever else. That builds the resilience to a relationship. And that's the same thing with retailers. You need to sometimes, if you go through a real tight spot with somebody, the relationship will be so much stronger out the other side because you've built trust that you've been able to talk through it and get it done.
Look at how you structure your funding.
In all circumstances, there's always opportunity to look for strategic funding opportunities, whether that be for a specific facility or whether that be for a short-term facility to be able to get you through a gap or to sell certain assets and effectively do a buyback or some sort of relationship. Those facilities are bespoke and they'll depend on your asset position and confidence in. And again, it go back to your personal relationship with people and your credibility. If you have a reputation which is less than credible, it'll be more challenging, more costly, and take longer to get all those facilities in place. But if you have been a long-term credible party with a good solid brand and a good solid business with a certain issue that's arisen, like you need to get rid of a few stores and you need to downsize and you need to transition through a few employees, effectively a restructure, there are parties there that we deal with on a daily basis who can come through and go, I understand how this works. Let's talk about how we execute this. And we put a plan together. Everybody understands their role. It's communicated clearly as transparent. And then you have decision to be able to make about, okay, I can either try and dig myself out here, or I can go through this restructure process and understand what it's going to cost, understand how it's going to work, understand the upside and the downsides and all of those things. It just gives you more flexibility. And again, it goes back to timing. A lot of these things come down to having enough time for your business strategy to turn around. Everybody knows that it's not working, but it takes a long time to be able to work out what to do to fix it. And sometimes the timelines just don't correlate. We had a client who was 3 months away from being able to bring their revenue back online and a total change of the business, but it missed. It just missed and it ran out of money. And that was because the product rollout was probably too tight and their major customer went, it's a bit tight for us at the moment. We don't want to do that. But if that had come online, they could have stretched for another 5 or 6 weeks and probably got there. But with the uncertainty about whether it was going to be 3 months or 6 months, they just ran out of money. And that was a relatively big business that had fallen over, because the restructure had been done, but just couldn't quite get to where it needed to.
Clever ideas for selling excess stock.
One of the things we've seen recently is some creative parties looking at alternative stock sales. And it may well become more common now that there is a global change in the markets with America changing its tariff position. That involved a supplier or wholesaler being able to access or use a brand to sell into a market that the brand was not in. So being able to, for example, sell into Europe, even though it was an Australian brand, to on a margin basis or a license basis to help both parties make more money because it was just a volume play, and that also could also bring down costs because fashion is a volume business. If you can increase your volume, but your cost base is, it could reduce your cost base because making 1 million things costs less than it does to do 100,000. And if you can sell the other 900,000 in a market that you are not in, or somebody else does it at no risk, it's a great outcome. And it's about looking for those and thinking about those. And again, working with your suppliers and saying, do you have somebody who could do that? Do you think that would work? How do we find a way through to have a commercial relationship that works for both of us to give you an income stream that you might not necessarily have and potentially bring down your cost base so you get a double hit and it doesn't actually really cost you anything, which is the definition of like a great business. It's almost like these tech businesses where it does not cost them anything to add another 10,000 customers. It's the same product, hence why they're so profitable. And that's what things people are looking at in retail to try and find a way through to be able to do that. That may be more prolific now that Europe are getting closer to China, and that market opens up a little bit more. Particularly because 95% of, or about 80% of the stuff coming out of China is for ASEAN and Europe. Obviously, they're the two biggest trading partners with China. Everybody thinks it's America, but America is actually third. And then the manufacturing aspect of the Asian countries, the ASEAN countries, so it's Asia Pacific, including Vietnam and all of those, which does a lot of the manufacturing for shoes, other things like that, which are potentially subject to 100% plus tariffs, going, well, if I can sell into a different market and still get my volume and maybe potentially increase it, and I'll still maintain America because who knows what happens in 4 years, but my pricing model will have to change. There's a great opportunity to be able to expand maybe volume and hold for a few years to see what happens and whether we revert back to a free trade or whether this becomes incorporated into a longer term play or whether we get some great outcomes from this of a really open trade outcome. It's just about being able to protect your business in the interim until we find out, get more transparency through the bumpy ride of the next few years.
Which do you choose, brand protection or business survival?
There are meetings where everybody is worried about protecting the brand. And the conversation is about, well, we don't want to sacrifice the brand. We've spent so much building up the brand. We really need to protect the brand. And then the next conversation, without irony, is about the fact that they have no money because they're not selling enough of the stock to be able to turn it into cash. And this is where at different points you need to be aware enough to be able to manage those issues and go, well, hold on, we need some cash. We need to actually pull back from our investment or protection of the brand and sell some stuff to be able to get cash to be able to let the brand continue. Because if we don't do that, the brand is not going to be worth anything because it's no longer going to exist or somebody else is going to own it. And that's where there needs to be that little bit of pragmatism to be able to work it out. And you can see with brands fracturing, and there's a cheaper version and a more premium version where they're finding that way in between. But it's always got to be relevant to be able to find enough volume to be able to, and we always look at it on the basis of find enough volume so that you can cover all your costs and then play around with the brand things to be able to try and drive further volume or drive further margin. And it's just making sure that you can move your stock at the right price for the right people and then being able to look at the expansion or the positioning or the relevance. And to a certain extent, the relevance of the brand and the brand positioning and value is that critical aspect, but it's not about protecting it at all costs, about moving it. This is not some sort of exotic European brand which only 5 people in the world can afford on a weekly basis. There needs to be scarcity, but you need to also have a business. So it's about balancing that business aspect with what you want to achieve with the brand.
Take control of problems before they become public.
For many retail businesses, we get involved and we look at it and we understand that there's an issue, but they don't quite know how to manage it or what a restructuring strategy looks like. So, and then we can sit down and go through it with them and say, well, there's the informal way to do this. We come up with a restructuring plan and we execute it and we gradually work through it. And then there's a formal way, which is more blunt, but goes through a formal process and happens very quickly. And that probably requires less funding because it happens through a formal process. So the realizations are done and paid and the costs get paid through that. But an informal process, generally you need some funding because there's a closure of a premises, there's exit of a premises, there's employees that need to be made redundant and all of those things. So you need to fund those to be able to stay solvent, to be able to continue to trade during those things. And that's where it becomes a threshold point of, okay, what is available to be funded and what is willing to be funded by the parties that you can access, and what does that allow you to do, and then what does the restructured business look like? So what's that forecast, or what is the formal process? Would you go harder because you can afford to do a little bit harder, and does that make more sense going forward? And what are the restrictive aspects in there? Is there a landlord that just won't play ball, or landlords that won't play ball so you don't have a decision-making structure? Or is the cost and the number required to do the restructure too high? So you end up having to do a formal structure, albeit you might have a plan first to be able to look at it. Because all of this comes back to giving directors and owners decisions and giving them enough data so that they can make the best decision and consider what they want to look at going forward. And that's a lot of this process leads to those sort of conversations where it's like, do you really want to be involved with this going forward, or is this you're done? Have you had enough? And should we be, rather than having this conversation, should we be having a different conversation? And we've had that on a number of jobs where we start off looking at, here's all the restructure, here's all of this, these are all the things we can do. We can go and spend all this money. It's all fantastic, but what do you actually want? Do you know? And when you ask them, a lot of them go, well, if we could transact and exit, we'd be happy. I go, okay. And then it's a different conversation because you go, well, somebody coming in might want the larger footprint and might be willing to bear the large footprint because it works for them. But you need to then go, okay, should we run that process first? So you can run a sale program first and transition it. You might do a few things to shiny up the business, but you might not do all of them because you can see that there'd be value for an interested party, and you need to do that at the same time. So restructuring is not a closed book of, well, you're either doing it informally or formally. It's about understanding the strategy and where people want to get to. And it can lead to a number of phases, like you look at a sale phase first. And if that produces the outcome that you're after, that solves a lot of the restructuring problem. You don't need to do it. But then you have the second phase where you can go into a formal restructure or an informal restructure. And sometimes you go informal restructure and you get to a point where, like that one I mentioned on another video, where they ran out of money before they completed the restructure and had to go formal. So there's a number of ways that it can play out. What you need, what the best thing is sitting in a management team with a director and the management going, okay, we understand what we're trying to do. We've set our strategy. Let's play it out and let the process take over and see where we get to. Be willing to adapt to it, think about it, but always have on the whiteboard, this is our strategy. This is what we're trying to do. And if we hit roadblocks, you go, okay, here's the options to go around it, but do we really want to do that? Or here's a bailout point. Do we look at that? And that's where it's really interesting, challenging, intense, emotional, I mean, I talk to clients about a restructure taking 18 months, even if the process, like it's done, but it takes 18 months for the business to sort of stabilize and get back to where they call it normal. And emotionally, that journey is probably that long as well. So it is very challenging on the individuals as well as those involved in the business and the business itself that has to adapt and change. I think everybody's been in that sort of mode since 2020 onwards in this constant change. And that's why you see a lot more lethargy in people at different points. And we see it with school holidays. When school holidays happens, the market just like stops. Whereas previously there'd be, oh well, we'd have a few conversations and things would be moving forward. Whereas now it's like, no, we're done. We're off for 2 weeks. That's it. I'll see you in 2 weeks. So unless the boat is going down the harbour alight, and even then sometimes it's just get the fire hose out and spray it with a bit of water, and so it doesn't go fully alight. But these days everything is done around those type of things because there is often key stakeholders who are just not interested in engaging during that period. Whereas pre-COVID, it would be all guns blazing. It didn't matter what time of year it was, whatever else, you'd be working Christmas Day if you needed to get these things done. So there's a there's an interesting change in the market, but there is still the same approach that you need to um, continually integrate what you are doing and interrogate why you are doing it to make sure that you're going along the right way in accordance with the strategy that you've tried to set weeks or months or years ago.
Conservative forecasting can put you in front.
One of the key things we see, particularly dealing with finance, is around forecasting, is that people don't factor in enough conservatism. They they to a certain extent shoot for the stars with their forecast, not thinking that that's what they're going to be held accountable to. And when that sale that they were banking on doesn't actually arrive, all of the assumptions start to fall away and the cash flow starts to change materially. So we always uh, sort of stipulating almost at an assumption level with your revenue and with the costs that drive off the back of that. You need to be very, very careful and you need to be very conservative about what you can actually do. So that means for a business that's been operating for 20 or 30 years, what do you know you are going to get? And then if you want to look at upside, yes, we can look at upside. But it's all about what you know you're going to get and then factoring your cost structure so that you can make that work. And then if you do get more, allowing for that extra revenue and potentially margin and profit to be used to sort out some of the issues that you are dealing with, whether that be extra payments to secure creditor, extra payments on payment arrangements with creditors or providers and suppliers and things like that, so that you have a set parameter, you know you can deliver underneath that, and you are not operating in a constant sense of the sword of Damocles is over your head, which creates more stress, which means it's more difficult to execute the things that you are trying to do and does not give you the impetus then to be able to do extra stuff to drive over performance. So if you do that and you can deliver on that, it calms everybody down. Everybody gets into a new state of comfort. You create a new state of comfort. We're within our operating structure. We know that we're going to continue. We've got all of that. Then they can take a breath, first of all, and then they can look for the things that are the extra 5%, the extra 2%, the extra 3%. And that's where you can start to um, build or reduce the things that you're trying to manage to get through, again, timelines. So if you've got a payment arrangement for 2 years, you're just in a holding pattern for 2 years, just paying off that debt, getting that under control. And then once you get out the other side, you're in a position to be able to do the things that you want to do or explore that because you have the cash flow and the capability to be able to do that. And also the supplier confidence that you've actually gone through that. If the 2 years can be reduced to 18 months because you've been more successful and whatever else, that goes to management credibility as well. And the fact is that confidence in the business is higher and you're on a springboard upwards. And that can often happen as long as you get that conservatism right, first of all, because everybody is more supportive and everybody is more willing to provide the extra things that you need to help you through it. Again, relating back to relationships, you're building stronger relationships because you're delivering on what you actually said you would. And then people build more confidence, and they come to you with ideas. They come to you with options because you are doing what you said you would do, and they want to help. Because people inherently want to help in these scenarios, particularly if you're a reasonable person. If you're not a reasonable person, they might not be less willing to help. But it all comes down to giving yourself capacity to be able to make sure you can deliver and then work from there. And if you need to change the cost structure and the cost footprint, well, you might need to do that as well to be able to make that work. But it's all about decision making from there. And you're not creating that rock for your back, and because you've got enough to do in that scenario and enough people to massage, enough people to manage. It's it's just about pragmatism as well. Overall message is I've been lucky to work in the retail industry for a long time. I've got some really good, reliable people that I go to when I have issues and be able to utilize their skills and their network to be able to find solutions. And that helps me when I'm running something or looking at something and trying to help, because it's not just me on an island trying to come up with a solution. And that gives you access to really key people all the way around the world. So the first thing I'd say is that if you need to look at those type of things, or you're just batting your head against the wall and you need to think about it differently, go and see somebody that you know or you're comfortable with who can be your confidant. I'm happy to have a chat with anybody who wants to do that. And I can introduce you to some other people who have great experience and great ability to be able to look at things and be able to see the challenges and give advice or an understanding. Sometimes it's just about the understanding that, yes, that's where it's at. Here's how I've seen it done before, to be able to give you some ideas about getting a plan together. Because ultimately that's where it all comes to, is that you need to get information so that you can make a decision, because that's where you get your outcome. And it also either alleviates your position and you go, well, I've tested the water and I know where it's at, or I have my options and I know which way I'm going to do and why. And that can give you a clear head and get you away from a lot of the other things that happen in this. We obviously do that a lot and have a whiteboard session and talk about it and work through all of these things. And sometimes, as I said, that leads to an hour conversation and it gives clarity to somebody who can go away and execute themselves, which we don't charge for. Other times it's like, okay, I need you to hold my hand. I want you to hold my hand. I want to go through these things. How do I message this? How do I massage that? Can you find me somebody who's got this expertise? Do you have a lawyer who can do this at this type of price? Do you have somebody who can just make sure that I am not overstepping myself? And do you have somebody who can help me with my supply chain? Can you somebody who can manage my supply? How do I bring my footprint down? I mean, there's a lot of brands now refining back to being two or three creative people and outsourcing everything else. And that makes a lot of sense, because if you've got that, you've got a perfect expertise to do the bits that add the value and do the brand recognition. The other bits are done, the grown-up bits that the creative people might not want to do, the boring ordering stuff, managing creditors, managing suppliers, and whatever else. Those things are mundane compared to the design thing, and clearing your mind for the design thing is important for some of these things. So if anyone wants to have a chat around those type of aspects or pass on viewpoints or whatever else, happy to always add to my knowledge, understand it. Um, I'm not going to have a great knowledge of high-end fashion. I'm just going to make that clear, but happy to understand how people make margins and how they are successful in their business, because I don't get to see a lot of the success in what I do. I tend to see the other more difficult areas. And for those people who are successful, there's always an opportunity to be able to buy something which is in distress and make more money out of it as a side project or to build into their current businesses. So it's just about thinking about it and using the skills you've obviously got if you've been successful. But the overall, best of luck with the detail and executing the detail in retail.